Hey everyone, me Kevin here. Why the heck is the market falling and what should we do about it? It's nuts, it's scary, and in my opinion, there are 3 catalysts for this and 3 things that we should do. Let's just take a look here for a moment. Rocket Mortgage down 15%. Enphase, the solar inverter company, 12%. Ubiquity, 11%. Zoom Video, bye-bye 40% increase. You got minus 10% 2 days in a row. DocuSign, bye-bye 20% increase. You get down 8% and then down another 10%. Tesla, how's 9.5% for you? Peloton, enjoy your 90. Oh wait, you're already down 10% off 90 again. Lemonade, you've been beat to crap for the last 5 weeks. How about another 8% down? You know, Apple, thought it was cool that we could buy that on sale? Yeah, 7.5% for you. Redfin, don't worry, you get some too. Minus 7%, minus 7% Etsy. Shopify's down, Microsoft's down, Salesforce is down. Everything is on frickin' fire. And not in a good way. It is sucking. And so what the heck is happening? Well, first, quick note, the coupon code for the amazing courses, I did extend for a couple days. It does expire later today, so if you do want to get in, I had to wrap up some bundle coupons, and you can still do that. Use that coupon code for the real estate course, the money course, the stock course, or any of the programs down below. Check those out. All right, let's now talk about the 3 issues because, well, they're problems. Number 1, the Federal Reserve, jobs, and renters. On Tuesday, the Federal Reserve released a statement warning of a downward spiral of inflation and the risks that low inflation has in potentially causing a worse future recession. On Wednesday, the very next day, yesterday, the Federal Reserve released their beige book, telling us how other than real estate and most of the stock market, the entire economy is suffering badly. We also heard from the Federal Reserve that more people are taking unemployment because schools are not properly reopening and parents are forced to stay home, reducing their productivity because childcare isn't available, and more pain is being felt in the economy because of that. At the same time, people are spending less money than obviously pre-pandemic. This is all very bad news for this week. And it's just the beginning, because today we got more unemployment data that said, hey, we just lost another 885,000 jobs for regular unemployment claims. But it wasn't just those unemployment figures, it was the fact that people who are self-employed had a higher rate of unemployment this week than last week. So things for people who are self-employed got worse, with another over 700,000 unemployment filings for them alone. And that's a separate filing. That's really bad. Tomorrow, we get new unemployment data, which we're expecting to finally fall under 10%. Yay, under 10% unemployment. But wait, it's still gonna be over 9%, which is almost 3 times what it was right before the pandemic. It's pretty high, somewhere around 30 million people on unemployment. This is not a great economy, and the Federal Reserve is just telling us what the truth is. They're not reading the stock market to tell us how great everything is. Now, the Federal Reserve is also backstopping the mortgage market, and, you know, the Fed says, after all, the bright spot is real estate, maybe because they're bailing it out. But the Fed also warns us that, hey, keep in mind, we still have a potential eviction crisis to be careful of. Sure, the CDC just banned evictions through the rest of the year, but tenants already owe $21 billion in back rent from this pandemic. Who's gonna pay for that? We got thousands of landlords and thousands of tenants here suffering, getting screwed. And no one believes Congress is actually going to do anything about this eviction crisis, which could potentially lead to a foreclosure crisis, especially once mortgage forbearance comes to an end and the evictions start getting filed and they come through. These are all longer term issues, and that's just catalyst number 1 spooking the market right now. Issue number 2, and this is not to take political sides, this just is what it is. We are 60 days away from a potential Democratic presidency, or at least knowing that we're going to have a Democrat president. It's also quite possible that we are 60 days away from a full Democratic sweep. That's where they take control of the House, the Senate, and the presidency. Now, I'm not here again to talk politics, but I will tell you what the market fears. The market fears full Democratic control, at least in part, because we already know that Biden has gone on record to say he wants to increase the corporate tax rate from 21% to 28%. That instantly reduces earnings per share at every single corporation in America, and that will be felt in the stock market. His vice presidential pick, Kamala Harris, wants to see the corporate tax rate not go to 28%. She wants to see it go higher, to 35%, which would hurt stocks even more. Now, realistically, for them to get this through, they would actually have to sweep the House, the Senate, and the presidency, which obviously we'll know in 60 days from now if they are successful in sweeping all these things. But if Democrats do end up sweeping, which is a possibility, then not only are we likely to see the corporate tax rate go up, which would affect stock valuations, we're also likely to see a financial transactions tax on stock transactions and bonds and dividends and options. Think about this kind of like paying a commission on stocks and options again, except this time you're paying it to the government, not to your broker. Then we're also likely to see a potential capital gains tax increase, making it more expensive to sell stocks or to invest. On top of that, we're potentially likely to see real estate tax loopholes get closed, like the 1031 exchange. Donald Trump, on the other hand, has proposed reducing the corporate tax rate to 15%. All of these things are creating a lot of uncertainty in the market. The Fed already tells us like every day the market's really uncertain and really volatile. This is just more. We are now within 60 days of knowing an answer. Okay, which direction are we going with taxation? Now, again, this doesn't mean I have an opinion on what's going to happen with the election, but what this does mean is there are going to be big changes related to finances in the stock market based on the outcome of this election and whether or not there is a sweep or not. Now, if you want a full breakdown of how much you might get taxed under a Biden versus Trump, check out a video that I made recently. I'll link it above or down below. Again, not politically motivated. It just shows you what each side has proposed. That's it. Now, the other factor that might also be getting priced into the market a little bit right now, and it's sort of part of this election thing, is no matter how the election turns out, we're probably going to see riots and protests worse than what we're seeing now. Think about it. You think the riots and protests are bad now? Imagine what happens on the night of the election and the next day and that weekend. Yeah. Number 3, the stimulus failures and hedge fund profit taking. Congress straight up sucks, okay? We know that. I don't have to talk long about that. We know that Republicans are having trouble agreeing to a $500 to $700 billion stimulus package. Democrats are demanding a $2.2 trillion bill. Donald Trump is willing to sign something up to $1.3 trillion and maybe even up to $2 trillion. We know that Donald Trump wants stimulus because stimulus is going to be correlated with the stock market going up, which might create more euphoria right before the election. All right, but either way, right now, we're at a massive stalemate. And here's what happens when Congress is at a stalemate, the Federal Reserve is a little pissy, and we're 60 days away from an election. People, especially hedge funds and mutual funds, have to show their clients that they're making money for them. And so what do hedge funds and mutual funds do? They take profits real fast. They love locking in profits. See, me as an individual investor, I hate taking profits because when I take profits, I have to pay taxes. So does a hedge fund and mutual fund, but not really. Because see, when a hedge fund or mutual fund sells shares to lock in profits, they get to send their client a statement. Like, here you go, client, here's your statement. Oh, cool, I made money. Honey, we picked a good mutual fund. We made money this quarter. Oh, we gotta pay taxes? No problem, we made money though. Right, fine. I get all the POVs, but the point is, when mutual funds and hedge funds don't sell to take profits, then they can't show big gains to their clients, and their clients might go to a different mutual fund or hedge fund. That's why there's so much profit taking. And so all it takes is a little needle like Tesla's gonna raise $5 billion in shares, and that's gonna reduce their stock price 1%, which will start the end of euphoria and the collapsing of tech values. Yeah, that sounds like the perfect needle to pop the bubble. Boop. And that means everybody taking profits. And after all, that's what Wall Street loves doing. They take profits to pay taxes. Not because they love paying taxes, but because they love showing their clients that they're making them money. That's why we always hear about Wall Street going, oh, yo, take profits. It's an industry norm. It's not something I do because I don't like paying taxes. Look, people always tell me to take profits. When Tesla was $400 before the stock split, when it went up from $185 to $400, I got comments and calls and emails from people all the time. Kevin, take profits, take profits, take profits. The same thing happened when Tesla was at $900 per share. Kevin, it's a 900, it's a bubble, it's gonna pop. Sure enough, it went down afterwards, but where is it now? $2,000. even after the fact that it's down 10% today. That's pre-stock split pricing, right? Divide by 5 to get today's pricing. The reality is I don't care to pay taxes because I don't want to give the government short-term capital gains and pay 35 to 50% on my money. I'd rather keep it and ride the waves of the market and take these opportunities to buy in. I don't have to prove to myself that I'm a good investor. I have control. I'm not a hedge fund. Anyway, keep this in mind. All of these things that we just talked about. The Federal Reserve fans panic with economic data and problems. The election is 60 days away. That's going to really rock the boat one way or the other. Again, no matter who wins, we're going to have protests and riots. And no matter who wins, there are going to be some big changes to the stock market. Probably. Depends if we get the Congress sweep as well. And people like taking profits in this country. That's kind of what we're seeing today. One of the parts. So, what should we do? Because after all, I mean, some of the stocks are still a little juicy. I mean, let's be real here. Look, we started this by complaining that all these things were down, but let's be real. A week ago, Rocket Mortgage was at like $18 a share. It's way up from there. Not that long ago, like 1 to 2 weeks ago, Peloton was at $65 to $69 per share. AKA, even though it's down 10% today, it's still at $81. The same is true for Tesla. A couple weeks ago, it was at $1,900. Now it's at $2,000 per share, pre-split pricing. That's more in my memory. These stocks are still relatively expensive just compared to like 2 or 3 weeks ago when they were much cheaper. It's insane. All right, so what should we do? Number 1, look for opportunities within realistic buying targets and don't blow all of your money. That means, yes, it's okay to buy a little bit at a time. If you have $10,000, buy $500 on a day like today. If there's another red day tomorrow, buy another $500 worth tomorrow. Buy a little bit every day, so that way you're psychologically participating in these red days and you're averaging in. Now, again, even though some of these stocks are down big today, it doesn't mean that they're going to go up again tomorrow. They could go down again tomorrow. If they go up, at least you bought a little bit. If they go down more, buy more. So keep in mind, yeah, it's totally possible we might see more of a decline, that this could be the start of more of a downtrend. Usually we see these sort of trade-offs between recovery stocks and these tech stocks for about 3 days. If that started yesterday, today would be day 2. Friday means we're probably going to see another red day for Friday. In my opinion, if you see opportunities right now, buy in light. I wouldn't go crazy buying in right now because, again, the valuations are still very, very high. In fact, my favorite way to buy in a day like today is to buy a group of 30 to 40 of your favorite stocks. It doesn't have to be like the S&P 500. It doesn't have to be that terribly diversified where you're getting more tobacco stocks than you're getting Starbucks. I personally like to use metkevin.com/1337v7. Yes, I just updated it to version 7. I'll link that down below. This is M1 Finance. So if you want to sign up and use M1 Finance, you could go to that link and you can create an account, and they'll actually give you $20 if you deposit $100 with M1 Finance to sign up for an account. But anyway, you don't have to. I just want you to be able to go to the link and at least see what the stocks are. I don't get paid anything for you just looking at the link. So think of it like free information and free stock holdings. I updated this portfolio to version 7 because I reintroduced Zoom after it just had, smashed earnings, but then also is now 20% cheaper after its earnings. I also decreased exposure to Tesla and Amazon slightly, and instead increased exposure for a little bit more stability in stocks like Google and Microsoft, just to stabilize the portfolio a little bit, especially post-split now. Step number 2, once you pick, getting into some of these opportunities a little bit and softly and slowly, step number 2, consider diversifying a little bit with a balance of recovery stocks. So even though 1337, in my opinion, has some decent diversity, it's very tech heavy. So I'd consider having some money also in recovery stocks. In my opinion, don't pick these individually. Don't go YOLO on Dave & Buster's and the SPG. Get like at least 5 to 10 recovery stocks. Carnival Cruise Lines, Delta, Dave & Buster's, Simon, whatever. Get at least 5 to 10 of these. I personally like using the basket at metkevin.com/recovery. That's the same thing. You can kind of see my allocations there. That's doing well today compared to the tech stocks, which are not doing so great. So on a day like today, I wouldn't necessarily be buying more of those recovery stocks. I'd be buying more of the other ones, but I do like having some of the recovery stocks right now. So if you don't own any yet, fine. get in a little bit. And again, we'll know later today, we'll know tomorrow how the next days look. For right now, all we have to do is look at the opportunities in front of us, and that might mean, hey, let's buy a little bit on red, but don't go all in as usual. Step number 3, big warning, folks. The Fed has been warning about this. Everybody's warning about this. Be careful. Debt warning. Be very careful about margin debt right now. We need to be consistent in realizing that it's very possible we could see pullbacks like this all the way up through the election, which means it's much more likely that we could start experiencing margin calls, especially if you're not diversified enough. This is why I like not going all in on one stock. And even though I love Tesla and I'm pretty heavy on Tesla, I make sure that I continue to invest in a lot of other funds or pies, so to speak, on M1 Finance to really diversify my money away from just one stock's volatility, especially if you're touching margin. I've also paid off my Webull margin and I'm paying off my Robinhood margin because it's too risky. And then I'll start working off my M1 Finance margin, which is a little less risky because they don't let you take out as much. So I love y'all. Good luck, my friends. Use that coupon code. Feel free to get a free stock with Webull as well if you want. If you deposit $100 with Webull, they'll give you one totally free stock between $8 and $100. It's a nice little start. You could sell everything if you want and take your money out of there if you want afterwards. But I think you'll like Webull. It's nice to have. Stay away from the margin on Webull is generally my recommendation. Feel free to sign up for M1 Finance. It's okay to have multiple brokerages. I do. And be careful with the debt. Realize also we've got Fed volatility, election volatility, and just an overall profit-taking market right now. That's my expectation as to what's going on rather. Buy in slowly and carefully. Use that coupon code, check out the programs down below, and folks, see you next time.